Hi, hello, and welcome all of you for Success Formula for You. First of all, let me extend my gratitude to all my viewers, subscribers, as well as the comments. Those viewers who have not subscribed to this channel, kindly subscribe it so that you will get all the updates. And if you feel you need videos on any other topic that will be beneficial to you for your career, you can place your requirements in the comments. Talking about this video, it's a video to discuss the basic and the fundamental aspects of financial accounting. This video will be beneficial for all those who are interested to know more about accounting as well as students of BCom, BBA, MCom and MBA for making themselves thorough in the various concepts related to financial accounting. Kindly share with all your friends as well so that at any time you can go through this video and clarify the meaning of any concept in financial accounting. Once again, reminding you to subscribe the channel and to press the bell icon. The American Institute of Certified Public Accountants define accounting as the art of recording, classifying and summarizing in a significant manner and in terms of money, transactions and events which are in part at least of a financial character and interpreting the results thereof. Accounts payable. This refers to the total amount of money that a firm owes towards its creditors and suppliers or vendors for the goods or service supplied by them and not yet paid. Accounts payable comes under current liabilities. The sum that the firm has to pay to all its suppliers is shown as the accounts payable balance on the company's balance sheet. Accounts receivable is the proceeds or the payment which the company will receive in the future from its customers who have done credit purchases from the firm. This comes under current assets and it is reflected in the asset side of the balance sheet. Accounting period is the time frame for which the firm prepares its financial statements and reports for the purpose of maintaining records as well as to report to the stakeholders of the firm. Accounting equation is the basic accounting equation, otherwise referred as the balance sheet equation, which represents the relationship between the liabilities, assets, and the owner's equity of a firm. And it is in the form of assets is equal to liabilities plus owner's equity. Accounting policy refers to the specific principles and procedures that is applied by an entity in preparing and presenting its financial statements. Accounting standards refer to the standard of accounting recommended by the ICAI and prescribed by the central government in consultation with the National Advisory Committee on Accounting Standards constituted under Section 210 of the Companies Act of 1956. Asset test. The asset test ratio, also referred to as the quick ratio, measures the liquidity of the firm or the ability of the firm to pay off its current liabilities. The quick ratio uses only the most liquid current assets that can be converted into cash within a period of 90 days. Firms with an asset test ratio of less than 1 is considered to be short of liquid assets to pay off the current debt obligations or bills, and it indicates a caution for the firm. Authorized capital. Authorized capital of a company refers to the maximum amount of share capital that the firm can issue to the shareholders. This is actually specified in the Memorandum of Association under the heading Capital Clause. Accrual refers to an entry that is made in the books of accounts of a firm with regard to the revenue or expenses paid but without any exchange of cash. Accrual basis accounting. Especially the two methods of accounting are accrual accounting and cash accounting. Accrual accounting refers to the system of accounting followed by firms where the revenue or expenses are recorded when a transaction occurs rather than when the payment is received or made. Cash accounting is an accounting method where the transactions are entered in the books only when actual cash is received or paid. Allocation is the process of distribution of one cost between different entities or different business units or cost centers. Balance sheet is the financial statement of a firm in a snapshot prepared at the end of the accounting period and consists of all the assets of the firm on one side and the liabilities on the other side and includes the owner's equity as well. It reflects the true picture of the financial position of the firm. Bad debts, a trade account receivable but turns to be irrecoverable from the person who was supposed to make a payment to the firm. Book value is the value of the asset that is mentioned in the balance sheet of the firm. The book value of an asset does not remain stable in all the balance sheet as the value of the assets are reduced every year due to the provision of depreciation. A business entity is an organization that is created either by one or more individuals to carry out the functions of a business and that maintains an existence separately for tax purposes. It may be a sole proprietorship, a partnership business, or a big corporation. Business cycle, also referred to as a trade cycle or economic cycle, refers to the natural rise and fall of economic growth that occurs over a period of time. Helps the businesses take efficient financial decisions. It is actually the downward and upward fluctuations of the GDP. Each business cycle has four phases: expansion, peak, contraction, and trough. Capital refers to the cash or other types of assets that are introduced in the business by its owners. It refers to the financial resources that businesses can use to fund their operations like cash, machinery, equipments, and other resources. Capital asset is a property that is expected to generate revenue over a long period of time. It is an asset that will be useful to the business over a period. According to the Cambridge Dictionary, a capital liability is a loan that is used to buy land, building, equipments, etc., or to pay for a particular project. A payment that is made by a person to discharge a capital liability is referred as a capital expenditure. It refers to the expenditure, the expenses that a firm spends to purchase, maintain, or improve its fixed asset, such as plant and machinery, building, vehicles used in business, or any other equipments in working condition. Cash basis accounting, also referred as cash method of accounting, is a system of accounting where the transactions of revenue and cash are recorded only when the actual transfer of cash takes place. Cash equivalents. This refers to the line items in a firm's balance sheet that reports the value of a company's assets that are cash or can be converted into cash immediately. It includes bank balance, marketable securities such as commercial papers, and short term government bonds. Cash flow refers to the net value of cash and cash equivalents being transferred into the business and out of it. Cash flow statement, referred as the cash flow statement, is a financial statement that reports the cash generated and spent during a specific time period. It also acts as a bridge between the income statement and a balance sheet by reflecting how money is moved in and out of the business. Cash flow projections. A cash flow projection shows the expected amount of money that will come into a business along with what will go out as expense. It is the breakdown of the money that is expected to come in and out of your business. Cash in hand, the amount of liquid cash held by the firm as on a particular day, is referred to as cash in hand. Call money is a minimum short term finance that is repayable on demand within a maximum maturity period of 14 days. Closing the books. This is an accounting procedure that happens at the end of each month or at the end of a year. It also refers to the entry of all the transactions pertaining to a particular period be accounted before the final accounts is prepared. Cost. In accounting terms, cost refers to the amount of expenditure spent for raw materials, equipment, supplies, service in the process of production by a firm. In the buyer's point of view, cost refers to the amount that is paid for purchasing a product or service. Cost of goods sold. Cost of goods sold, also referred as the cost of sales or the cost of service, is the cost that the firm incurs to produce the product or service that it deals with. It includes the direct materials and the direct labor expenses made for the production process. Marketing or advertising expenses are not included in this. The formula for calculating the cost of goods sold is opening inventory plus purchases during the year less ending inventory, that is closing inventory. Credit in accounting terms refer to an agreement to purchase a product or service with the express promise to pay for it in a future date, also referred to as buying on credit. Credit note. A credit note, also referred to as credit memo, is a letter that is sent by the seller or the supplier of goods to the customer, notifying him that he or she has been credited with a certain amount due to an error in the original invoice or due to the defect in the goods that is dispatched to the customer. Credit sales. The sale transaction in which the payment of a particular sales will be made at a future specific date is referred as credit sales. Credit purchases. The purchase transaction in which the payment of such purchase invoice will be made at the end of a specific time period referred to as credit purchases. A creditor is an individual or an entity that lends money or extends credit to another party. Current assets refer to either cash or other assets that can be converted to cash within a period of 1 year. Examples are bills receivable, debtors, marketable securities, etc. Current value, a method of valuing assets and liabilities which takes into account the change in prices as an alternative to historical cost. Debit note is a source document for the purchase returns journal. It's a document given by one party to the other party stating that such other party's account is debited in the books of the sender. Default refers to the failure to fulfill an obligation, especially to repay a loan or appear in a court of law. It refers to the failure to repay debt, including its interest as well as principal on a loan or security. Debenture. A debenture is a medium to long term debt format that is used by large companies to borrow money. It is the most common form of long term loans for the firms. Debtor. Debtor is used to describe the party that owes money to a company or individual after an invoice is sent for goods or service. Debit. A debit is an accounting entry that results in either an increase in asset or a decrease in liabilities on a company's balance sheet. Deferred income, also known as unearned revenue. Deferred revenue or unearned income refers to the advance payment received by a firm for goods or service that have to be provided or performed at a future date. Deferred expenses, also known as prepaid expenses or accrued expense, refers to the expense that have been paid by the firm but has not incurred the same. It is actually a cost that has been already incurred but which has not been consumed yet. Depreciation is a systematic process for allocating the cost of an asset that is used in a business pertaining to the accounting period in which the asset is being used. Depreciation is associated with buildings, equipments, vehicles, and other physical assets which will last for more than a year but will not last forever. Diversification dividends is a technique that reduces the risk by allocating investments across various financial instruments, industries, and other categories. The main aim is to maximize the return on the investment. Dividend yield, the annual dividend per share divided by the share price, is the dividend yield. Drawings refer to the act of withdrawing cash or assets from the company by the owner for personal use. Discount received, a supplier of goods or service allows a business to deduct an amount called a discount for prompt payment of an invoiced amount. The discount is often expressed as a percentage of the invoiced amount. Discount allowed. A discount allowed is when the seller of goods or service grants a payment discount to a buyer. Discount allowed is a reduction in price of goods or service allowed by a seller to a buyer and is an expense for the seller. Double entry system of bookkeeping is a system of accounting that recognizes the fact that every transaction has two aspects and both the aspects of the transaction are recorded in the books of accounts. Doubtful debts. These are debts owed to a company by the customers or borrowers which may possibly not be paid because the customers or borrowers are in financial difficulty. Earnings per share. Earnings per share or EPS can be defined as that share of a company's profit that is distributed to each share of stocks. It is calculated by dividing the company's net income with its total number of outstanding shares. It's a tool that market participants use frequently to gauge the profitability of a business. Expenses. An expense is any money that is spent or cost that are incurred as a business, individual, or organization attempts to generate revenue. The expenditure refers to the amount spent by the business organization for the purpose of purchasing the fixed asset or for increasing fixed asset value. Equity is the amount of capital invested or owned by the owner of a company. The equity is evaluated by the difference between liabilities and assets recorded on the balance sheet of a company. Fair value is a rational and unbiased estimate of the potential market price of goods, service, or assets. Fixed cost. The fixed cost is the cost incurred by the firm and that remains fixed for a certain volume of output. In other words, the cost that does not change with the change in the output. Financial gearing ratios are a set of financial ratios that is utilized to make a comparison between a company's debt to other financial metrics such as business equity or company assets. Fictitious means fake or not real. These are not assets at all, but they are included in financial statements. Expenses incurred in starting a business, goodwill, patents, trademarks, copyrights comes under expenses which cannot be placed in under any headings. Fictitious assets are the assets which has no tangible existence. The general ledger is a master accounting document providing a complete record of all the financial transactions of the business. Gross profit is the revenue that is left after deducting the cost of manufacturing the product or providing a service. It is the income a business has left after paying all direct expenses related to the production of a product. Gross margin is a firm's net sales revenue minus its cost of goods sold. It is expressed as a percentage. The things which are bought and sold by the firm are referred to as goods, but when purchased in business, purchases will be debited. When sold, sales will be credited. Intangible assets are those assets which have no physical identity or presence but has long term value for the business. Hope all of you found this interesting, and if you like this video, please subscribe the channel as well as don't forget to press the bell icon so that you get all updates that happens in this channel. Thank you for watching this. Please do not forget to share this link with your friends so that they also get benefited, and keep waiting for the updates in the forthcoming week. Do not forget to subscribe.